Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. And it's a happier look. The ties are gone, the suits are gone. And we are, in traditional attire. I just want to say, wish all our viewers actually a very happy Ganesh Chaturthi. Tomorrow, of course, is a market holiday. We'll all be celebrating and going to visit the Ganpati idols, and it's a festive mood. It's a festive mood which now hopefully stretches from now, at least if you just go by the roll of festivals, all the way to the end of the year. So this kind of sort of kicks this off. Well, you've got markets to track, which I'm not sure are going to be in such an upbeat mood, and we'll talk about that in just a bit from now. I'm Prashant, with me my colleagues Mangalam and Reema. Guys, hi, morning.
Hi, welcome back, Mangalam. It's a truncated but an eventful week. And we're starting off with a lot of global headlines, as you can see on your screen.
Yep, and the more important part, Ganesh Chaturthi is the start of all things good. It is also the remover of all obstacles. So maybe for the market, for all the uncertainties that we're seeing, may Lord Ganesha be very, incredible and make it a very smooth sailing highway as against the bumpy ride that we've been having so far.
Well, let's hope that definitely is the case. And, let's just take it from the top, as we always do then, and tell you what you need to know. Because there are two things. I mean, not new things, actually. There's just one new thing, but there are two things I want to address right on top, right? So US has notified additional 25% tariffs. This is, of course, the allegation that President Trump has been making that India and its purchase of Russian oil has been fueling the war between Russia and Ukraine. So those tariffs are going to take effect from the tomorrow morning, 9:30 a.m. basically, Wednesday morning, and markets are shut, of course. 9:30 a.m. those tariffs will take effect. So that is point number one. It's nothing new, but for those, and this has been notified now. At the margin, there was a very small minority who were kind of, and why not? I mean, people who were hoping that last minute, and being so ad hoc. So many countries have seen tariff deadlines come and then, 24 hours before, even closer to it, deferments. So at the margin, maybe there was some expectation that something will be worked out. It's not happened. So we'll have to sort of go through this. I will still say this, that, cumulative 50% tariffs on a permanent basis, I don't think that's possible. We'll obviously work this down. But for now, this takes into effect tomorrow. We'll just have to see how long these kind of sort of last and stay with us. So that's one. Secondly, news coming in this morning that President Trump has, in the U.S., fired Federal Reserve Governor Lisa Cook. He's been sort of course, threatening. This was in relation to allegations by a Trump loyalist that she's engaged in mortgage fraud, submitted wrong information in her mortgage applications, etc. And news coming in that he's sort of asked her to go. This, of course, could be challenged in courts, federal courts, and then finally the Supreme Court as well. Remember, Lisa Cook earlier, after these threats, pushed back quite hard, saying, well, I'm not going anywhere. But now that this has come to pass, we'll see if this actually goes the route of the courts. How will markets react to this is the question. I mean, remember when President Trump was attacking Powell with full gusto, there were questions around whether institutional integrity in the U.S. is under question and whether U.S. exceptionalism perhaps will take a bit of a hit. All those questions, of course, I think they were there for a bit, but markets roared back, especially led by the AI stocks, the big tech AI names. S&P 500 last night closed about 0.4. NASDAQ was down about 0.25% or so. This is, of course, is small pullbacks after Friday's massive gains. Russell, remember, on Friday was up 4%. Nvidia was up 1%. It's ahead of the earnings report later today. Yields across the curve, US curve, closed higher. Again, retracing some of the cuts that we saw on Friday. So the 10-year was up 3 basis points. Oil prices have moved up as well, 1.6%. We are back at about 69, but it's been a range 67 to about 70, and both, the upside and downside, those ranges have held. Kevin Hassett, who's a national economic advisor to President Trump, said this on CNBC, and we'll play out sound bites as well, that U.S. could take further stakes in companies similar to the investment in Intel. He spoke about how Fed's a little bit late to the game, nothing new. And of course, he also indicated Trump's decision on who should succeed Powell is months away. It's not now. Remember, Powell's term only ends in May of 2026. But as I said, we'll play sound bites out. Nothing very new in these comments. Just tying in the levels and putting that out. We've had a nice, almost now 7-day uninterrupted run from the lows. And this is where we find ourselves at. The resistance for the Nifty, 25,153, which is nothing but the high that we saw earlier. And 25,702 is the support, which is again the swing high when the market was still down and out. So 25,153 on the upside, 24,702 on the downside. For the Nifty Bank, the numbers will come up on your screen. Resistance is the 20-day and the 40-day. Remember, on the Nifty Bank, the recovery has been extremely weak. So the Nifty got to 61.8 and then last Thursday turned back from there. The Nifty Bank has not even done 38, as I've been saying. So 55,568 and 55,841 are those two averages, which are resistances. And support for the Nifty Bank stands at 54,905, which is the recent low. And then 54,055 to 54,442, which is the gap zone before this rally actually started. So those are levels. GIFT Nifty gives you a quick sense of how we're likely to start. And we'll pick it up from there. 70 points lower is the implied open. But how is the F&O setup looking? Mangalam is standing by today to tell us exactly that. Mangalam, over to you.
Well, it is the monthly expiry week, and we have a truncated week. Tomorrow's the holiday, which implies that the expiry happens tomorrow itself. If you look at the setup for the F&O, you start with the indices that moved yesterday. It was the IT index that actually led the Nifty higher, and it was more export-facing than domestic names. So the Nifty Bank was underperforming. It has been underperforming in the recent past as well. But yesterday, the support came in not only from IT, but we had the metals and the pharmaceutical index doing extremely well as well. All that has happened over the last few years, or last few days rather, the big up move that we've seen on the Nifty, if you look at it from the series start to now, it's been just about 200 points. And that's what the FII exposure also indicates. It started at 10% on the long side and now moved to about 13%. So neither has the Nifty moved a lot more, nor has the FII long exposure increased a lot more as well. And the Nifty Bank has been a bit of an underperformer. In fact, over the last 3 trading sessions, the Nifty itself has been making lower highs. So 25,154 turned into 25,085. And yesterday's high was a little over 25,000 itself, very close to the 50-day moving average. Can this change? That's the big question. Because ahead of expiry, the FIs have actually written more puts than calls. 54,600 puts and 7,000 calls, telling you there is support at the lower levels. Even if you look at the options, which were fairly active in trade yesterday, we had the 25,000 put, we had the 24,950 put and the 24,900 put. All of them fairly active in trade, and the premiums out there suggest that there could be support between 24,800 to 24,850 for the Nifty. Though on the way up, the Nifty has to cross the 50-day moving average. The important part would be what the Nifty Bank does, because despite the underperformance yesterday, the FIs actually went up and bought 285 crores in Nifty Bank futures, which was much higher than they bought in all the other sectoral futures, including the Nifty. So can the Nifty Bank perform in today's trading session and over the next couple of trading sessions? And secondly, can the Nifty stay above the 50-day moving average is the key thing that I'll be watching out for going forward. In terms of stocks, just 1 day ahead of expiry, a stock that has had a tumultuous series is PG Electroplast. For being in F&O ban for most part of the series, now it's out of F&O ban. So that's one thing I'll be watching out for.
Thank you very much for that. Let's move on and get to the equity calls then of the day. Yogesh Agarwal of HSBC says India is expensive for valid reasons. They include higher ROEs, higher long-term growth potential, and the domestic appetite for equities. He believes the perceived risk for India is lower due to strong and proactive regulatory framework and institutions. That said, near-term slow growth and long-term deterioration in ROE are downside risks.
Okay, all right. Those are some views which are coming in. Prashant Paroda is now joining us. He's portfolio manager, emerging markets at Allspring Global Investments. And we also have William Lee, chief economist and executive director of the Milken Institute. Gentlemen, great to have both of you here. Thank you very much for your time. William, as we were saying earlier, so for those, and why not, right? I mean, there's been a fair bit of ad hocism in terms of deferments and extensions, etc. At the margin, maybe there was some hope that there'd be a deferment and talks would continue. But I guess these will kick in now tomorrow morning our time. and then talks will continue. William, how are you seeing things from your vantage point?
Well, I had said on the show a while ago that India was really at that position in early this year where it could have asked for almost anything, given the goodwill with the president and the vice president. It's unfortunate that time has passed and all of that goodwill has dissipated, in part because the rules of the game that President Trump has set up is that you will get low tariff rates if you invest in the U.S. and if you create jobs in the U.S. and you open your markets to U.S. companies. India, unfortunately, hasn't done any of that. What's more, the strident positions it's taken with the BRICS countries has really caused President Trump to be upset over the possibility that India is actively working to find an alternative to the U.S. dollar. So all of these circumstances, unfortunately, have really put away a lot of goodwill. But the fundamentals are still there. That India is still a very special country. India will also be granted very special status because it is a special country. It is the alternative to China for production. It is a marketplace that is a growing marketplace that every company wants to be in. So all these fundamentals still hold up quite a lot of hope for some sort of agreement whereby U.S. and India will not decouple, as it were. And in fact, integrated complementary investments will be the keynote going forward.
William, at what point will foreign investors find value in India? For the last 1 year, India has greatly underperformed many of its emerging market peers. And now, for all the reasons that you spoke about, the long-term story perhaps still remains intact. At what point will value emerge now in the emerging market basket? And for investors, or for you, how would you rate the emerging markets now?
I'm not a big believer in the notion of value investment because things are cheap for a good reason, and once they're cheap, they might go cheaper. So I think the key to look for, I think, in most investors' mind is what will turn things around. Is there something about the circumstance of India that will catalyze change that wasn't there before? And right now, the catalyst that everyone is looking for is China alternative, right? India is the China alternative. And a way of diversifying your supply chains. And India already is a huge marketplace. So I think in terms of prospects going forward, I think on average, capital will continue to flow to developed economies because of what I've mentioned before, the Lucas paradox. But India will get its share of portfolio diversification and also investment complementarity. That's a very key notion, that investments in the United States have to be complemented by industries that are developing in India that complement the kind of developments that go on in the United States. Technology is very, very multifaceted, and India has got those facets of technology, and like pharmaceuticals, for example, right? India has really been the biggest producer of pharmaceuticals, and whatever medications you want to develop in the future that are high-tech and AI-driven, it's going to start with India.
What about, India's own domestic market right now? The shift has become on consumption, where the regulatory authorities, the political authorities, everyone is pushing for consumption improving in India. And the second half typically is a lot better considering the festive season, etc. as well. Do you think that has seen an improvement? And on the tariff front, now that 25% is notified, 50% was threatened, what happens next here? I mean, what are the next courses of action that everyone should keep an eye out on?
Smart thing to happen next would be to find the exemptions, right? Tim Cook found exemptions. Jensen Huang found exemptions. And I think going forward, there will be circumstances whereby important sectors of the Indian economy will find exceptions. And as far as the domestic economy is concerned, the reason why people are so optimistic about India is because it's a rising middle class. It's a huge population, very, very diversified, and unfortunately highly stratified. Super rich, super poor, but that middle is quite considerable, and that represents a marketplace where companies around the world want to partake in that kind of growth.
Right. William, last time we spoke, we touched upon a few other things as well, which I think if there's time, I'd like to sort of revisit it. Prashant is with us as well. Prashant, what is your sense? As an India investor, and you've got large amounts of money in EMs in India as well, how are you seeing things? I mean, At one level, one can argue that, so far these tariffs, etc., have not made too much of a difference to the markets per se.
No, I continue to believe the secondary tariffs, which is the additional 25%, that is more a Russia-Ukraine issue. And I think from time and there is still work being done to set up a meeting with President Putin and President Zelensky. So to the extent that, something comes out in the next few months on that, I think the 25% will be removed whenever there's progress on peace talks. And it's just kind of a stick that is being used for Russia today to get in line and continue the peace talks. So I think the 25%, presumably, if that's a temporary phenomenon, you get back to a 25% again. And then, as William talked to, you continue to engage with White House and talk with exemptions. So maybe you can potentially go from 25 to even 20%. But it looks like even the South Korean president was here today and talking in the White House, and looks like the 15 or 20% will stick. And obviously, South Korea came up with additional investments that they'll do on the U.S. side as well. So I think we have to think outside of the box to get that 25 to 20% for India.
Prashant, the other bit with the developments on the Fed side in the US specifically, do you see a reaction?
Well, I think, there's definitely going to be a change of guard at the Fed. And, a lot of Fed followers always continue to say that there is some political element within the Fed as well. So I think a change of guard, even Chairman Powell himself at his speech said that he's open, to potential cuts given where the labor market is. So I think we should expect to see cuts even with this removal and maybe additional personnel coming in place of Ms. Cook. I think we continue to see a little bit dovish Fed. Clearly, the tariffs are going to there'll be a data coming out in September, CPI linked data. So it will be a little bit data dependent on that. But I think the labor market is a bigger concern for the Fed today.
Okay, all right. We'll leave it there, gentlemen. Prashant and William, good to speak with both of you. And we'll touch base again over the next couple of days. Thanks once again. We'll take a quick break, but before that, let me just quickly run you through what's lined up here in terms of interactions. So we'll at 8:30, we have Abnish Agarwal of PL Capital join us with some fundamental stock analysis. 9 o'clock, Sandeep Agarwal of Sovilo Investment Managers to talk about the IT space. IT was, of course, the one big heavyweight sector which did the heavy lifting. 9:20, Karthik Kumar of Axis Mutual Fund talks to us about markets. 9:35, the management of Narayana Health to talk about demand trends. 26 outlook. In our special segment, Charting Trends, Rahul Sharma of JM Financial Services will be with us at 9:45. And we'll talk stocks, sectors, charts, everything. And of course, towards the end of the program, it's the economy, Lata in conversation with Santanu Sengupta of Goldman Sachs on the impact of 50% tariffs on Indian goods by the US.
Right, with that, we'll slip into a short break. But as we do that, a lot of stock-specific action to track today. We will get to all of that in just a bit in our special Top 10 segment. But for those who are looking at a short list, we have Aditya Birla Capital, Tata Motors, Protein eGov, ONGC, IRB Infra, NHPC, and so on, BLW as stocks that are on the back of positive news. But we have some of these textile stocks, Vodafone Idea, Sai Life Sciences, and the others, which are likely to open in the red on the back of news flow.
Welcome back. It's a cautious start to begin Tuesday morning. The Gift Nifty is down close to about 70 points, reflecting the weak or the muted global cues, the imposition of the 50% tariff deadline effective tomorrow, 9:30 a.m., and perhaps the monthly expiry on Thursday. But what about stocks? Our entire research team is standing by with CNBC TV18's list of top stocks for the day. First up, it's the tariff imposition, which could put the spotlight on textile makers. Harmis now joins in. Harmis.
Morning, Rima. And of course, the textile stocks have been in the topic of conversations ever since this tariff announcements came into play. And of course, it was the Trump administration that has notified that these additional 25% tariffs will take effect from 9:30 tomorrow morning Indian time and 12:01 a.m. Eastern time from the 27th of August. Now, which were already reeling under that 25% tariff, now they'll have to pay a 50% tariff. And textiles does not, of course, come under the list of exemptions. So a lot of these names, be it Gokaldas Exports, KPR Mills, Wellspun Living, all of these companies, we've spoken to them in the past. They've mentioned that these 50% tariffs are almost unsustainable and they will have to pass on those additional costs to the end customers eventually. And Gokaldas, in fact, was down almost 5 to 6% in yesterday's trading session itself. So now, once this announcement has now made official and all of these companies get at least around about 30 to 70% of their top line from the US market, so that will have an impact. So expect all of these stocks to open in the red today as well.
All right, Hormaz. So those textile stocks in the red, they have been underperforming. Now with this being notified, maybe some bit more of selling. Gaurav joins in on AB Capital. Gaurav, some stability at the top.
Well, yes, definitely we can say that, because now RBI has approved the appointment of Ms. Vishakha Muley as MD and CEO of the company. And with this, they have also approved appointment of Mr. Rakesh Singh as Executive Director and CEO of NBFC segment. Now, specifically, if we look at the leadership under Ms. Vishakha, we have seen a very good growth in AB Capital. In fact, she was appointed and she was nominated by Board of Directors on 31st March 2025, and now the RBI approval has come through. When we look at the history, she replaced Ajay Srinivasan as CEO and took charges in June 2022. And after that, we have seen a strong rally in the stock as well. In fact, the stock has gone up almost 3 times. If we look at her appointment, she already holds a very strong background, comes from ICICI Bank. And under her leadership, we have seen company taking digital capabilities to a next level and also leveraging the group's ecosystem. Under her leadership, we also saw offerings actually expanding across loans, investments, insurance. So definitely a good positive changes is what we have seen in the company. Shareholders have also been happier ever since she has joined. And after that, this appointment and the RBI approval is a big positive thing that we think can work out well for AB Capital going ahead.
Okay, all right. So that's Aditya Birla Capital in focus there. Gaurav, thanks for that for now. Vodafone Idea should also be in focus. Remember, the stocks come up quite a bit from the lows of 6.5, 7 rupees. It's actually from lower levels then. 7.5 yesterday, about 5% higher. And there's been some expectation that, on the AGR dues, perhaps there will be a moratorium of some sort, which provides relief for Vodafone Idea and in turn for names like Indus, etc. as well. But we were able to speak with a government official yesterday. Ashmit is here with what he picked up. Ashmit, over to you.
Well, we had a detailed conversation with the Minister of State, Dr. Bemasani, and when faced with the same question as to how, if at all, any relief can be managed, if relief can be proposed for Vodafone Idea or for the broader space, on that one count, he clarified that this is an issue that is up to the management, that they are best positioned to take this forward. From the government's perspective, they said that as of right now, there is nothing that is being discussed at this time, and that said that all that the government had to do, it has already done, that it will not be able to provide any further relief, that they were referring to, of course, the equity conversion of about 53,000 crores. And on that count, they said that the stake where it is currently at 49%, it will stay there, that any relief that they had to be contemplated has already been done. As of right now, the Minister of State clarifying that there's nothing on the government's plate, there's nothing on their table, they're not discussing any relief for Vodafone Idea. Again, clarifying that this is an issue that is best dealt with by the management. Now, this will become critical for Vodafone, given as how the moratorium on the AGR dues runs out by March of 2026, which would mean that subsequent to that, there will be annual payments of about 18,000 crore rupees that will get triggered. This was also an issue that the management was faced with in their latest earnings calls, where they said that they're looking at non-banking channels for raising funds, given as how the banks have been waiting clarity from the government whether or not any relief packages can be worked out. But the big takeaway being from that interaction, the Minister of State clarifying on record that there's nothing on the table, the government is not contemplating any further relief, and that this is an issue that is best left to the management of Vodafone Idea.
Thank you very much for that. Coming in very clear from the government, no intervention, no future relief. The company is on its own. The stock actually did well even in Friday's trade. On Friday, the stock had rallied close to about 7-8%. It followed it up with a gain of about 5% yesterday. And today, some of that may get undone. Sudarshan is now with us for more on Tata Motors. Sudarshan, what's the news?
Good morning. So what has been in the works for last 4 years seems to be reaching a desired conclusion very soon. So the latest update regarding Tata Motors is NCLT, that is National Company Law Tribunal, has approved scheme of arrangement that company's board had approved in 2024, that was in March month. And they had approved that commercial vehicle segment of Tata Motors will be demerged and passenger vehicles that would consist of electric vehicles, JLR and the PV segment will be one company, and share swap ratio will be in the ratio of 1:1. So shareholders will get one share in CV segment, CV business, for one share that they hold in Tata Motors. So what's next? Now, after NCLT approval, company will file the detailed order of NCLT with Registrar of Companies, and appointed date as already announced, that was April 1 of 2025. Effective date is likely to be October 1, 2025. So come Q3 of FY26, you will have two companies from Tata Motors stable, that is Tata Motors CV and Tata Motors passenger vehicle.
All right, Sudarshan, thanks a lot for that. So that's about Tata Motors. But Vivek joins in. He's got on his radar Sai Life Sciences. Vivek, a clean out trade.
Good morning. Absolutely right. A very large block deal is expected to take place in Sai Life Sciences. We accessed the term sheet yesterday. So as per the term sheet, TPG Asia Fund that holds close to 14.7% of the total equity of the company is looking to completely exit its stake in today's block deal. The base price for this particular block deal is at a discount to yesterday's closing. The base price is at 860 rupees a share, implying that the total size of the block would be slightly northwards of $300 million. It's a clean out trade. We are going with the red given the fact that it's a very large offering that we are seeing. But it'll be interesting to see whether post this particular clean out trade, the stock can recover or not.
Okay, all right. Management seems to be pretty confident, and the outlook seems to be pretty strong. We'll have to see once this is done what the stock really does. 905, 906 on Sai Life. Vamakshi is here with a list of other stocks and news. Vamakshi, morning.
Well, good morning, Prashant. Festive greetings to you and everyone in the studio. Protein eGov is the first counter that we're watching out for. Good news for the company because they've won a 6-year contract worth 1,160 crores from UIDAI, which is the Unique Identification Authority of India. This is to establish and run district-level Aadhaar Seva Kendras. ONGC is the next counter on our radar. They've commenced natural gas sales from Chinewala Tibba Gas in the Rajasthan Kutch online exploratory asset. And they've commenced sales worth almost 1 lakh standard cubic meters of gas per day. IRB Infra is the next one we're watching out for. They've received provisional completion certificate for the Vadodara-Mumbai Expressway. They are now eligible to receive biannual annuity payments from NHAI for 15 years, and the project is expected to generate cash of almost 180 crores rupees annually. NHPC, not great news for this counter because the commercial operation of around 85 megawatt solar capacity of the Karnisar project has now been delayed. The earlier date of commissioning was August 31st. It has now been pushed by a month to September 30th. Lastly, keep an eye out on Sona BLW. Some green on the screen could be expected for this counter because they've received PLI certification for 3 products, 2 for traction motors for E3-wheelers and 1 for traction motors for E2-wheelers.
Thank you very much for that. Protein eGov, a stock that she spoke about in July when the news came that the company is no longer being shortlisted for PAN 2.0 project. The stock that time was at 1,400, and since then it's not quite managed to recover, still hovering around 800 rupees. July was the time when the stock got slammed. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Aditya Birla Capital, Tata Motors, Protein eGov. You've got ONGC, IRB Infrastructure, NHPC and Sona BLW Precision. Stocks with negative news flow are textile stocks, Vodafone Idea and Sai Life Sciences. All right, that's equities. What about commodities and currency? Manisha is now joining in for a complete roundup. Manisha, good morning.
Morning, and thank you for that. While, of course, the big news is the 50% tariffs now it's standing in for India from 27th of August midnight, and that is something that the markets will see an impact on various sectors, as you mentioned. But for the international markets, it really is about the weakness in US dollar. A 25 basis point rate cut from the US Fed in the month of September, almost getting baked into many of these prices. And the third important thing to watch out for is the Russia-Ukraine conflict, where we've seen an escalation coming yet again. But in the background of that, there is a statement from the US president warning of additional tariffs on Russia if there is no progress to the peace deal in the coming 2 weeks. So the market's clearly juggling with a lot of things here. We have seen the crude oil prices trade near a 3-week highs because of the supply concerns and, of course, the weakness in US dollar. In the metals as a sector, there is a gain across. Silver gained a percentage point overnight. It's trading very close to its 2011 highs. Gold prices gained up as well. Aluminum currently is trading at a 4-week highs because of supply concerns coming in from Guinea, Mozambique, and, of course, China. We also have seen stronger gains come in for iron ore prices. Those gained by 2% overnight. And copper, with a fourth straight day of gains, is also trading at a 1-week highs. So strength coming in for commodities, but it's more to do with supply concerns than demand, really.
All right, more to do with supply than demand. Manisha, thanks a lot for that. That's about the commodities arena. But a lot of the brokerages, they've written on a few stocks. We do have Sudarshan joining in with the top brokerage calls of the day. Sudarshan.
So in the brokerage corner today, I have 2 Nifty stocks and 1 recently listed companies. First one is Reliance Industries, top Nifty contributor, and it's going to hold the AGM this week on Friday, that is 29th of August. So UBS has resumed coverage on the company with a buy call and targets given of 1750. It says it's building India's digital and new energy future, and Geo and retail are entering a harvesting phase. About O2C, it says diversified O2C reduces cyclicality as new energy scales up that are expected in coming years. It expects new energy to start contributing to total EBITDA from FY27, and it sees there is a room for re-rating in the stock considering the value potential that it has. Next is Titan. Bernstein has initiated coverage with an outperform call, and target is 4200. It says company is best placed to capture increasing formalization and contemporization of demand in India, and it has storied legacy of 23% EPS CAGR for last 2 decades, and it trades at 5-year low PE due to 3 major news. First one is rapid gold price increase, second is increasing competition, and third is natural diamond LGD dynamics, and it forecast 18% revenue and 25% EBIT CAGR over FY25-28. Last one is JP Morgan has written Anthem Bio that was listed last month. It is initiated with neutral call, and target is 820. CMP is around 843. So it says it's innovation-led, tech-focused CDMO with leading capability in small molecule, and it's expanding into high-growth segments such as ADCS, peptides, and some of the more molecules, and it forecasts 26% EPS CAGR over FY25-28. But on the valuation front, it believes that it's trading at a premium if you compare against DVs and sector average, and that's the reason valuations look very capped, and that's the reason target price is below its CMP.
Okay, all right. So Reliance, there is Titan, and then there is Anthem. 3 calls, more coming up a little later. Thanks for that, Sod, for now. We're going to take a quick commercial break here. There's 25 minutes to go for the pre-open session to kick off. We'll have Ajay Sahai, Director General and CEO of the Federation of Indian Export Organizations, join us on the other side as we talk about Trump tariffs, which the additional secondary 25% tariffs also kick in. Which are the sectors which get hurt most? How's the industry dealing and preparing for this? Stay tuned, coming up.
Welcome back. You're watching us here on Bazaar Morning Call. It's one day to go for the US government deadline to double tariffs on India to 50%. 25% of that has been notified already. The government officials have said that trade negotiations with Washington are ongoing. Meanwhile, Prime Minister Narendra Modi has vowed support for Indian farmers and small entrepreneurs as the US's additional 25% tariffs come into effect tomorrow. Let's hear him out.
मेरे देश के लघु उद्यमी हो, किसान हो, पशुपालक हो, हर किसी के लिए मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है। मेरी सरकार लघु उद्यमियों का, किसानों का, पशुपालकों का कभी भी अहित नहीं होने देंगी। दबाव कितना ही क्यों ना आए, हम झेलने की अपनी ताकत बढ़ाते जाएंगे।
Okay, that is the Prime Minister essentially assuring that he's going to do everything possible. The government will do everything possible to protect the interests of course, small businesses, agricultural, the agriculture industry, and more. Ajay Sahai is, of course, with us. He represents Indian exporters. Mr. Sahai, great to have you with us here. We spoke yesterday, and good to have you back on the program. So this, is, of course, has been notified. And when we were talking yesterday, there was this small, sliver of hope that maybe last minute something happens and talks continue while tariff imposition is extended. Doesn't look like it now with these having been notified. So just want to straight up ask you, which of the industries most hit, most impacted, sir?
In fact, 55% of India's exports, which is subject to reciprocal tariffs, covering textile, gems and jewelry, leather, toys, handicraft, chemicals, certain engineering goods, plastics, all this will be impacted because from 27th, we will have 50% tariff, whereas most of our competitors are having tariff in the range of 15 to 20%, and the difference of 30 to 35% will not be possible for industry to bridge in. They don't have that much of profit margins, and therefore, I'm pretty sure that in September, we will see export to US dropping down drastically. The good thing is that 45% of the export, which is under Section 232 or in the exempt category, that may continue for some more time.
Yeah. The other thing is, it's like you start with 50, if you start with 50, you end up finally with 25 whenever this is negotiated lower. But 20, when we started all of this, 20, we were not looking at 25. We were looking at an advantage compared to other exporters. Take apparels, etc. Textiles is a case in point, Mrs. Hai. What's your sense? I mean, this 25 secondary tariffs perhaps at some point go, but would that leave us with 25?
No, I think please bear in mind that the countries who have got the lower tariff, including Indonesia, Vietnam, EU, or the UK, they have some kind of bilateral trade arrangement with the US. We are also engaged in the BTA with the US. Once the BTA is finalized, even this 25% will come down to 10 or 15%, depending on the negotiation, give and take. So properly, we are looking into the situation where 25% penal duty, which is on account of the Russian import of oil, may change with some kind of truce happening between Russia and Ukraine and other factors. The balance 25% will come down when we finalize the BTA. So finally, we are looking into a kind of stable situation with India at a tariff of 10 to 15%.
Do you think that is possible, 10 to 15%? Because 25% has been notified already. And going on from here on, by when do you expect any sort of conclusion on the negotiations which are underway?
In fact, the negotiator was supposed to be in India this week. Unfortunately, they have not come. I'm sure the backroom diplomacy must be working. And we are also hopeful that very soon they will come on a negotiating table. As and when the BTA is finalized, please bear in mind that the top two leadership has given a terminal date of fall of 2025, which is still a few months away. and therefore we have time till October to finalize the deal. And I'm pretty sure that the deal will be finalized. These are certain hiccups which has been witnessed by us, but as a long-term roadmap, India's US relationship is of a strategic nature, and these kinds of hiccup will not derail that. We are hoping that negotiation will commence soon, and once the negotiation conclude, India will be in much better position than many of our competing countries.
So, Mr. Sahai, morning. So, we still keep the hope alive of an eventual tariff of 10 to 15%. But in the event, it is 25%. How would you assess India's competitiveness? And two, in the interim, while we are slapped with a higher tariff vis-a-vis others, how are exporters' concerns being addressed by the government? What steps do you expect?
In fact, as of now, a lot of them has done the front loading of exports so as to build the inventory. The problem may not be there for a month or two. Probably US is having a very large inventory at this point of time. The challenge is, of course, the finalizing the order for the summer season, particularly in textile and footwear segment, where the buyers are holding to the order, looking into what would be the tariff on India. If this 50% tariff continues, as I told, that most of the sectors will be impacted, except the sector which enjoys the exemption either under Section 232 or having the zero tariff. So roughly $47 to $48 billion of India's exports will be at stake if this 50% tariff continues. Even if the 25% penal tariff is withdrawn and 25% remains, probably exporters, importer may enter into some kind of negotiation to absorb the additional tariff. Please bear in mind that 10% is the minimum tariff in US now. So we are talking about a differential of 5 to 10% with most of our competitors. And generally our competition from Southeast Asia and South Asia, they are close to 20%. So we are talking about the 5%. Probably the 25% penal duty is hitting the exports very badly. And had it been just the 25%, it could have been managed. But we are not losing hope. We are hoping that negotiation will start. And once the negotiation concludes, we will be in much better situation.
Okay, Mr. Sahai, we'll continue to sort of get your feedback from you because you're clued in to most exporting industries over the next couple of days as well. Thank you very much for joining us for now. Amnish Agarwal is with us. Amnish, good morning. Good to have you with us here. Thanks for joining us. You know, as Mr. Sahai, who represents exporters, said, of course, I mean, continue to hope things will get resolved. And he ultimately hopes, given the strategic nature of the long-standing partnership, this is more of a hiccup and, tariffs are lower. From a market point of view, so textile apparels were the hardest hit. I mean, look at Gokuldas exports. Yesterday was the biggest volume-led loser, ended another 5.5% lower, at about $700. What's your sense, Amnish? It's of course looking pretty. We don't know when the resolution happens, but would you look at buying some of these names if they are beaten down enough, with, of course, the assumption or the belief that, I mean, of course, 50% will not be permanent.
Go ahead, Prashant. So, see, as far as the entire basket of exports to US is concerned, say, for example, when it comes to your iPhones or pharma, so many segments are still exempt. But as you said, there are a few segments like, for example, your textiles is there, your textile including your home textiles, your marine is there, okay, leather is there, so gems and jewelry are there. So these are the segments which are definitely going to see some pressure. Particularly, I think textile, the hit will be there. But for some of the companies, exports to US have been a very significant part of their total sales. And my sense is that the resolution with US is going to take time. It is not going to be a, you can say, a straight-jacketed thing, because it is not only about tariffs. It is about much bigger geopolitical game which is being played as of now. So at this point of time, yes, everything at a certain price becomes a buy. But I think for the time being, it is, you can say, now the entire action, the impact will start flowing in, which can actually take some of the stock prices even lower. So while in the long term, yes, once the things resolve, things will bounce back, and there could be, you can say, a scope to make good amount of return in some of these stocks. But till the time some clarity comes, even if say it is a quarter or two, I think there could be still significant downside in many of these stocks.
Right, the drama continues from Wall Street. Amnish, just hang in there. We, have some lines coming in from Lisa Cook, who Donald Trump, fired yesterday overnight, and there was some weakness on Wall Street on account of that. But now there are statements coming in from Lisa Cook at the bottom of your screen. She says that no cause exists for the US president to fire me. In fact, she goes on to say that she will not resign. So obviously, there are shots fired from both sides. There is uncertainty. But it's interesting where Donald Trump has said something, whereas Lisa Cook saying that no cause exists for the US president to fire me. The independence of the US Fed and the governor saying that she will not resign, and the US president has no authority to fire me. We will obviously monitor this story as this goes along, may have some market implications as well. But Amnish, the IT pack that did well in yesterday's trading session, the street believes that maybe better days are ahead and the worst perhaps is in the price. Would you concur with that view? And if yes, then how would you like to play it? Via the large caps or maybe some of the mid caps?
You see, IT has been weak from quite some time in terms of, say, number, in terms of outlook. Also, there is no great guidance which is coming as of now, which started with slowdown in US and currently also, I think in terms of numbers, yes, in some segment there might be some stability, but there is no great clarity even now. Now we need to look at it from the angle that so far US economy has been holding on, and the inflation numbers have been under control because first of all, there's a lot of inventory which has been built up into the system to, you can say, prevent any big impact of these tariffs. But in some of the essentials, the prices have even gone up by 20-30%, but that is not a very big part of the total basket. So if this kind of you can say the tariff wars with various countries, it continues, then inflation in US is definitely going to go up, and which could impact demand. And you can say lag impact of that can even start coming on some of these IT companies. So I would say that IT in the current juncture is more like, I would say it offers value. There's a dividend yield also. But in terms of visibility, there is very limited visibility on the ground. Now, if you want to play IT stocks, I think Infi is one stock which we have been liking. And in addition to it, you can say look at maybe say an LTI Mindtree, which again is doing good. Persistent is also a good stock, but I think the valuations there, they have been quite rich.
Amnish, do stay on. We need to slip into a very short break. On the other side, we'll continue our conversation. We'll also get in a few technical trading ideas. Sachidanand Utekar and Sudarshan Sukhani join in with the top trading picks for this morning.
Can't hear PGM. I can hear you.
Yeah, we don't need you to hear PGM.
हाँ, हरमज ये जो डिलीवरी परसेंटेज होता है ना,
हाँ, yes.
वो परसेंटेज का कोई मेरे ख्याल से इतना मतलब नहीं है.
But that's, I just mentioned it for the heck of it. It was not something that was trendy or
because you should look at delivery yesterday versus number, because delivery वैसे इतना होता है.
Welcome back. Asia is lower today following the weakness on Wall Street. The Nikkei, the Korean markets are down over 1%. The Taiwanese market Straits Times 2 are down close to about 1/3 of a percentage point. And that GIFT Nifty too is suggesting a bit of a cautious start. But yesterday we had a modest gain. The benchmark indices closed up with a gain of about 0.4%, and there was strength in many pockets of the market. IT was one, paper stocks. So while we did see big gains in the stocks, let's find out how the volumes and the delivery volume shaped up in these counters. Hormus now joins in with those numbers. Hormus.
Two pockets dominated headlines yesterday, as you mentioned. One was IT and the other one was paper, and the delivery volume suggests two contrasting tales here. You start off with the paper names, of course. You take a look at JK Paper, Tamil Nadu Newsprint, West Coast, Andhra Paper, and take a look at the sheer volumes with which these stocks moved yesterday. Almost 2.5 crore shares traded on JK Paper, the 20-day average of just over 2 lakh. And in comparison to Tamil Nadu Newsprint, West Coast, Andhra Paper, all of them saw anywhere between 70 to 90 lakh shares traded, and 20-day average is anywhere between 70 to 90,000. Then you take a look at the delivery volumes as well. Now for JK Paper as well, almost 20 lakh shares that were marked for delivery as compared to a 20-day average of just 1 lakh. The 11.5, almost the other names also saw anywhere between 5 to 11 lakh shares marked for delivery, and their 20-day average for delivery as well ranges anywhere between 30 to 50,000. So it shows the very heavy volumes and the delivery correspondingly as well. On the flip side though, IT was another pocket. And most of these names, they did move higher, but they moved higher on volumes that were almost around about their 20-day average, not significantly higher. In fact, HCL Tech's volumes yesterday were lower than their 20-day average. The 28 lakh shares traded yesterday, 20-day average of just 32 lakh. And on the delivery front as well, almost 50 to 70% of those shares were marked for delivery, and for Infosys and for TCS as well. And in fact, for TCS's delivery volume was lower than its 20-day average, but for the other two, it was higher than its 20-day average, but not significant. The other name that you want to watch out for today is Vodafone Idea, because of the fact that in the last 6 sessions, the stock has gained in 5 of them. It's up 20% in those 6 trading sessions. And over the last 2 trading sessions, every session has seen more than 100 crore shares being traded in terms of daily volumes. And the last time this happened, when 100 crore shares were traded in a single day on back-to-back occasions, was back on the 24th and the 25th of June. And what you also need to watch out for is that there were almost 23 crore shares that were marked for delivery in yesterday's trading session, as compared to a 20-day average of just 12 lakh. And when it comes to the daily traded volume, yesterday's volumes of 116 odd crore shares was also higher than their 20-day average of around about 46 to 47 lakhs. So it is IT, it is paper, but of course can't take your eyes off Vodafone Idea in today's session as well.
All right, Hormus, thanks very much. Very, very interesting stats there. So in the case of paper, I mean, we don't talk about it, right? It's a very small space and no real analyst coverage or anything of that sort. But you know, we spotted this early yesterday, and of course, it's never one. It's always a pack, and the delivery numbers are up on your screen. So very, very large numbers. I spoke to, since there's no coverage, I spoke to one of the top packaging companies, which basically, so all these companies, paper companies, are clients. I mean, they sell paper and paperboard, etc., to this large packaging company. I think one of the largest in the country. They said it's quite significant. The impact is quite meaningful. And guess where bulk of this comes from? Where the minimum imports China. So it'll immediately increase capacity utilization for all these companies. And the import duty is on this virgin fiber paperboards, which is nothing but, I mean, the packaging material that you use when you get a package from Amazon, etc. So the feedback I got is it's anything between 35 to 50% of revenues for companies like JK, ITC. ITC, of course, won't move the needle because it's on a stock basis, but those are the two companies, at least the feedback I got, where this is the most significant. The other thing, of course, is that demand has been a little weak. But yes, this GST cut, etc., is able to fire up demand a little bit. I mean, that also at the margin helps things. So just thought I'll put that up. We'll try and get an analyst from maybe one of the credit rating agencies to talk to us about what they make of this. And of course, we've been trying to get to the managements as well. We'll take a break. We're back. The pre-open session comes up. Sandeep Agarwal of Sovilo Investment Managers, of course, joins in to talk about the rally yesterday we saw in the IT services space as well. Stay tuned.
Welcome back. Moments away from the pre-open, 15 minutes away from the market open itself. The GIFT Nifty indicating about a 70-point downtick at the open. The Asian markets mildly in the red after the US markets closed lower yesterday. So what should the technical setup be like? Let's get in Sudarshan Sukhani and Sachidanand Uttekar for a quick check on the indices and individual stocks. Sudarshan, good morning. We've seen higher levels over the last few trading sessions, but those higher levels have been lower than the previous day. And there has been supply at levels slightly above the 25,000 mark as well. Do you think the index is now consolidating at a higher range and this range-bound trade is likely to play out?
Yeah, good morning. See, what's happening is that every day is becoming a different day. We had a buy on dips opportunity yesterday. Today it's the exact reverse. And there's a message here, a larger message. When there is a trend, most days give an opportunity for buying, whether it is on a breakout, on some days it is on a dip, some days on a consolidation. But because there is an absence of trend, we are having a buy day, then we are having a sell day, which is essentially today, and maybe tomorrow we'll have something different. So you're right, the selling is coming at higher levels and the markets are perched very, at a very risky point. Once we go below 24,850, we start filling the gap which was created on Monday. That's not good news, and it will create something called an island pattern, which is for the technicals. But all said and done, today is a day when we want to go short. So keep a stop at 25,000 and look for an intraday, and it's all intraday. Look for a decline to wherever we go.
So you were short at open. If we open down, gap down, 50, 60, 70 points down, you would still go ahead and short?
Yeah, that's right. Obviously, we always wait for a cooling off period, but the trade is to go short today.
Sachidanand Uttekar is also now joining us. What would your call be for the day, assuming we have a gap down opening? How would you play it?
Good morning, Bima. Good morning, Mangalam. I think Sir has already filled in all the details here, but if you look at the overall structure, I think there is multiple support evidence at 24,810, 24,840. So I think that will be a very good deep pocket wherein some contra longs should be initiated. If you look at last few trading sessions, the Nifty has been more consolidative. Yes, the 25,000 hurdle is remarkable, but if you look at the supports, there is good amount of evidence that 24,840 would act as a very strong demand zone. So I think going long near that support would be a prudent idea. One can keep a stop loss at 24,840 on closing basis, and probably we may see the Nifty, oscillating within this range of 24,940 on the higher side and 24,840 on the lower side.
Okay. Let's get in a few trading ideas then. Sudarshan, your stock calls?
Well, UPL is a buying opportunity with a stop under 707. IndusInd Bank is an intraday short, stop above 785. Sun Pharma is a buy. It's also a positional buy. Sun Pharma is a buy with a stop under 1624. And Indus Towers, again, it's a buying opportunity for the day and a positional buy with a stop under 348.
Sachidanand, your stock calls?
The setup of ITC is looking promising. If you look at the last 15 trading sessions, the stock was in a declining trend. It has formed a bullish hammer formation right at the support zone of this particular declining channel. What we are expecting is that there could be a rebound soon. One can play with a stop loss at around 396. A rebound is expected towards 406 to 410. So it will be on the long side. The second stock, which is looking good, is the Exide Industries. After 14 weeks of consolidation, we have seen fresh signs of breakout. The 50-week exponential moving average is also crossed with the positive crossover on its weekly RSI. So we are expecting momentum in this particular counter. The trading target is placed at 422. Positional target is at 436. We are recommending building fresh long position in Exide, keeping a stop loss at 396 on closing basis. And on the short side, there is some exhaustion in Apollo Hospital. We have seen a bearish engulfing kind of formation. The resistance at 7950 is looking very strong. So we are expecting that there could be a pullback move, which can be participated with fresh shorts. Keep a stop loss at 7980 on a closing basis. One can expect a move towards 7650.
All right, got that, Sachi. Thank you so much for that. We'll come back to you for trades at 10 as well. Meanwhile, just watch out for a couple of stocks. Sachidanand did speak about ITC. Things may be falling in place for ITC once again because the GST rate rationalization coming in for the tobacco business. The belief is that maybe it'll be rate neutral. Not a major change from either side, and there wasn't a much change that came by on the budget front as well. Consumption, on the other hand, is likely to pick up, and now with paper doing a slightly better as well, all things may come together for ITC. The stock's been stuck at around 400 for a while right now. The other stock that I'm looking at is BLS International Services. That's because the ticker team tells us the company's gone ahead and won orders worth nearly 2,055 crores from the UIDAI, which is, the Aadhaar centers. And this is a little more than what we saw for Protean eGov as well. Protean eGov saw 1,600 crore worth order win coming in from, to keep Aadhaar centers. That stock is up around 7.5%. Obviously, it's taken a big knock on account of the PAN 2.0 going away from it as well. So some positive for them, but a bigger positive for BLS e-services. Amnish Agarwal still with us. Amnish, on ITC, do you have a view? Do you think things are coming together with the paper stocks seeing a bit of a rally? ITC likely to be a beneficiary of that as well. Small part in their overall pie, but things aren't looking very bad for them.
I think ITC, the situation overall, I think it's bottoming out because paper, in the overall scheme of things, one might think it is small, but a couple of years back, they had an EBIT of 2,600 crores, which has literally halved from that level. Now, I think once the duty has come, which is more on the paper board, which is the forte of ITC, being the market leader. I think more than 80-85% of ITC's volumes are from paper board only. So I think the profits will come back. They will, I think, virtually double from here, plus the acquisition of Century paper and paper boards, which they did. So I think it is going to be significantly accretive to ITC over the next, say, year or so. So I think in terms of paper and paper boards, the profit will at least double over the next couple of years. That is one. Even in terms of, I think, cigarettes, the volumes have been good now with the raw material prices softening, plus if GST rates are also likely to be more on the neutral side, I think things are bottoming up. Even FMCG looks, I think, set for some sort of a recovery. So ITC is actually a topic in the entire consumption space.
Got that. Amnish, stay on. We also have with us on the show Sandeep Agarwal of Sobilo Investments. Yesterday, we saw all the IT stocks rally in trade. In fact, the Nifty IT index was up close to about 2.5%. So some signs of life in the beaten down sector. Sandeep Agarwal, fund manager, is now with us. Sandeep, you've consistently held the view that these are tough times for large cap IT companies. They're only going to grow in mid-single digits, 4 to 5% best case. AI is deflationary. But keeping all that, even assuming that's true, IT companies grow 4-5%, at least at the large cap level. Are valuations still turning fairly attractive, maybe for a 10-15% kind of stock price return for the next 1 year, given the fact that the dividend yield, the yield, free cash flow yield, they give you buybacks, etc.?
Yeah, hi, good morning, and thanks for having me on the show. So, Rima, if you recollect, every time we are saying same thing that, large cap 5-6% growth is also good growth, and we don't see more than that. But as you rightly mentioned that, when we are now speaking to a lot of fund managers and others, they are saying that, it is the new defensive for us. So many of them are replacing actually FMCG because for similar growth, rather than paying 50-60 multiple, they are good at paying 20-25 multiple. Same dividend distribution, buyback support is also there. So I think, it is more of a tactical move by many of the funds and many of the investors who are simply replacing, lower, higher multiple with lower multiple stock with similar outcomes. So that is what is happening in large cap. And I think that will continue to happen. And maybe because of that, you can see some upside. But structurally, the things are a little deflationary. As you rightly mentioned, on the AI side, the efforts are going down. So it will take some time for the reset to happen.
Tell us about the positioning. You spoke about how investors are now tactically turning bullish on IT. They're replacing consumption with IT. There was this Phillip Capital sales note last week which said that the FIs have been selling IT. We've seen outflows of $4.1 billion in IT since March of 2024. The assets under custody have fallen from 10.3% at the start of this year to 7.4%. Even domestic ownership in IT is at an all-time low, which means that there is a case for some weight increase. Would you concur?
So, it is very tough to say why the weight increase should happen. But yes, because, if you are shifting from some other sector to other, then there could be some increase. And there is a peak of pessimism also, to be honest, right now, because And because of that, you can see some reversal and some uptick. But structurally, the industry is in a very different mode right now. We saw the wave in 2022 when mid-caps did phenomenally well, all this persistent KPIT, Coforge, Mindtree and all, because earlier the contract sizes used to run in hundreds of millions of dollars. They got broken down into smaller when digital came, and that's the reason the mid-caps, which generally did not get the benefit of large contracts, started getting benefit of small, mid-sized contracts, and that you saw the massive re-rating which happened in the mid-size. I think now in this wave with AI, the contract sizes have even gone much smaller. And you will see a lot of money to be made in very, very small size companies, because for them that $50,000, $100,000 contracts will also be game changing. So I think this is the wave in which you will see similar kind of money which mid-caps made in 2022. This time in 2025, very small size companies will make tremendous amount of money in a very short span of time. That is what my call is. And large cap will remain 5-6% growth, mid-cap will remain 10-12% growth, and the small one will be 20-25% growth, and they are at really lower multiples. So big money is there in terms of percentage returns.
Okay. So the thing to do is forget about the large caps as an investor, Sandeep, as a strategy, right? As we go through the next couple of, and this is a trend which will be with us for a while. You're saying forget about the large ones, focus on the small caps in the ITs. That's a strategy investors should pay attention to?
Yes, absolutely. Because Prashant, this is the reason, everyone is taking out money. Also, if you see the FIIs, they get the trends right very early. So I'm telling you, the nature of the contracts are shifting in a way that you will no more have 500 million, 1 billion contracts. Means there could be one or two cases. There are no more so much of transformational deals and all. They got broken down to 100, 150 million dollar in 2022. Now they are broken down into 1 million, 2 million, 3 million. So obviously now the small caps are the one which will be able to participate in those deals. So I'm saying even the large caps will take their model to do this transaction. Mid cap will also do, but for them to see a meaningful change on their overall scheme of things will be taking 3-4 years. But for the small caps, it will immediately start showing in 2-3 quarters. So I'm extremely positive on the very small size companies which are doing niche work, and there are a lot of them. And you will be surprised the way they will make returns, the same returns which Mindtree is and everyone has made in 2022.
Okay, just list out 3 names. Top absolute return ideas.
So we run a PMS and we hold some of them, so I will not be able to tell you the names, but I'm telling you a simple scan on a screener or any other software will give you those names. Just need to check what kind of growth is there, what kind of margins are there.
Sure.
I'm very positive that the small caps will make tremendous money.
Sandeep, quick word. Even BPO companies, the small BPO companies are good buys?
Yes, I think so, because they are using a lot of tools. Even the large BPO companies you should look at there, there is a lot of business coming in.
All right. We'll leave it there. Sandeep, thank you very much for joining us. Really appreciate it. So I think it's a pretty clear view coming in from Sandeep in terms of what you should do and how which names, which at least parts of the IT services space you should approach. And he's saying focus on small caps. That's where growth and money will be made. Well, let's just focus on some more. Actually, let's just put up some stock stacks. And this is stocks we put out earlier on with news, etc. Aditya Birla, Tata Motors, Protein Ega. Protein Ega was the big one, right? 6% rally on the order with regards to Aadhaar services. I think it's a 1,000+ crore order. ONGC, IRB Infrastructure are the other ones. NHPC, Sona, BLW, Precision, etc. come up. Tariff impact. We'll just take a look at this as well. Gokuldas, of course, was the big loser yesterday. Wellspun Living, Indocount are some of the others. So, of course, more coming up. Vodafone Idea, 4% lower. Yesterday was up about 5-6%. From 6.5, it had moved to about almost 6-7.5 rupees. So a little bit of pullback after the comments from the Minister of State. Sai Life Sciences block, and we'll see what's happening there. 3% lower, about 380,000 shares at this point. What are the calls coming in at this point? Just 2 minutes before market open. Sudarshan is here with that. Sudarshan.
Well, it's Sun Pharma. Consider buying Sun Pharma with a stop under 1624.
All right, you speak about Sun Pharma. Sachi, your thoughts? All right, let's get to Sachidanand in just a bit. But Sudarshan did speak about Sun Pharma. Ekta joins in. She's got some important news coming in for both Zydus as well as Sun Pharma. Ekta.
Well, yes, I'll start with BofA Securities, which is written on Sun Pharma. They've downgraded the stock to underperform with the target price cut to 1570 versus 1730. According to them, specialty-driven earnings provide some medium-term visibility, but they expect slower revenue ramp-up from new launches compared to consensus. Sun may pursue further specialty acquisitions, but the upside is already priced in. Most favored nation clause on news flow continues to weigh on their drug Illumia. which is Sun's largest specialty drug. It's trading at around 32 times FY27 PE versus 10-year average of around 25.5 times. Investec on Zydus Life Sciences, they have a sell with a target price of 940. It's up around 6% in the past month versus the Nifty Pharma, which is down around 2%. Now unfavorable given valuations and earning risk. Mirabegron, ER and Revlimid generic together contribute around 35% of FY26 EBITDA, but both face risks of disappearing without backup products. It trades at around 28 times FY27 EPS and peers trade at around 24 times.
Okay, all right. Let's just look at what, Ekta, thank you very much for that. We've got market open coming up in just a bit from now, just a couple of seconds away. We'll look at indices as we always do, at least the open on the Nifty 50 stock stack, and then we'll get down to individual names and see what's happening. So 24,899, about 0.25% lower. The Nifty Bank is down about a quarter. The small cap index is flattish. This is all, of course, as markets open up. First rates, so 24,900. So it's about a 0.25% cut there. Bank Nifty is unchanged. Although the Nifty Bank, of course, has been the big underperformer as compared to the Nifty. I think it is a little lower now, 0.2 lower on the Nifty Bank. Mid-cap index is down 0.4. And I think the small-cap index will come up on your screen. I think there also, there perhaps is a bit of a cut coming through. So 0.3% lower. So across the board, uniform 0.2, 0.3 on the 4 indices. Nifty heat map, how the Nifty 50 stocks opening, how many in the red, how many in the green, and what is that picture looking like? Overwhelmingly in the red. So Titan on one end, and on the other side you've got Sun Pharma, which Ekta has been, of course, talking about, which is starting lower. So that's the picture, at least as far as the Nifty 50 is concerned. It's a 50-point lower start on the index. Rima.
Well, both brokerage calls. So on the way down, Sun Pharma, Ekta spoke about the BOFA downgrade to underperform. Target price 1570. The stock currently is at 1630. So from here on, after the near 2% fall, there is limited downside, but that's your top loser right now. And other pharma names like Dr. Reddy's, Apollo Hospitals also trading in the red. ICICI Bank is struggling a bit. This month, ICICI Bank is lower by nearly 4%, and that's dragging the overall banking complex index with itself. Reliance Industries has opened trade on the softer side. It's got a cut of about 0.4%. Bharti Airtel is reeling with some losses, but this is after a big outperformance year to date. Bharti Airtel is up nearly 20%, and some of those gains are being given up. You've got softness in a couple of global-facing companies like Tata Motors, Tata Steel, JSW Steel too in the metal universe is weak in trade. On the way up, not too much, but some buying has emerged in Nestle, Titan, where Bernstein likes Titan. They say that this company has been delivering an EPS growth of 23% CAGR for the last 2 decades. Target price set by Bernstein is 4,200. Some auto names, two-wheelers, Eicher Motors, Hero Motor Complex are in the green. Nestle India too, higher. But all in all, not big moves either side.
Not big moves either side on the frontline end of things, but in the broader markets there have been some big movers. So for starters, we have Sai Life Sciences, which are down about 4%. That large trade that Vivek was alluding to has taken place already. 874 rupees per share, 15.4% equity. But more importantly, remember the floor price was 860. So let's see whether there is some recovery from the lows on that stock or not. Protean eGov is up 9.5% on the back of the order win that it has gotten from the Aadhaar centers. The other company that got an order win from the Aadhaar service center is BLS International Services. That stock too up around 4%. Yatra Online is doing well this morning. We have Edelweiss Financial as well, up around 5.5%. But interestingly, after a big move yesterday, JK Paper opens 3.5% lower. So the question is whether there is some purchase at lower levels on these paper names or not. We have Kitex Garments, which is lower by 5% as well. So the textile sector, obviously, on the notification of the 25% tariff, not doing too well. Just one stock I'd like to point out, that is Vedanta, which is optically showing a 17 rupee downtake. But remember, the stock goes ex-dividend today. The dividend on Vedanta was 16 rupees. So if you adjust for that, the stock is down just about 1.5 rupees. So absolutely flat for Vedanta, as against the optical downtake of 4% on account of the stock going ex-dividend.
Okay, I think we've got the rates coming up across the board. 100 points lower is where the Nifty is now starting at. 2:1. I mean, it's still very early, right out of the gates, but 2:1 declines to advances ratio on the Nifty. But as I said, is early. Now, what else? Guys, Karur Vaisya on my screen is showing a big downtake. I'm not sure if it's accurate. We should just put up, okay, nothing. Apologies, that's, I thought so much. Well, Sai Life is the biggest. Of course, there's that block which has gone through. It's down 4%, 871. And Mazgaon Dock is down about 1.6, 1.7%. PG Electroplast has come up, from the recent lows of about 480 or so. It basically rallied about 100 rupees from the lows. So it's down about 2.5. Indus Tower. So there's, of course, Voda Idea, which is lower. But Indus Tower is also down about 2.25% at this point. And so on and so forth. Zydus Life is down about 2%. So that's another one, right? 1,003 odd rupees. The paper names, right? JK Paper is down about 3.5% after yesterday's 13-14% move. So we'll see where that one goes. Hyundai is down 2%, 2418. Action Construction Equipment was up 10% yesterday. That is down about 2.25% as well. I'll go down the list, but volumes then will start to thin out. So I guess we will just wait here and not move down. Protean, I think we already highlighted, full 11% higher on Protean eGov. Of course, it came off from 1,600 rupees or so to the recent lows, which was about 750, and stocks back at about 900 now. Edelweiss is another one, Mangalam, which is up about 5% as we start today's
session. There's a large block deal in Edelweiss. 6 million shares have changed hands. So that's the reason why it's moved up on very large volumes.
And just a word on Karur Vysya, because you thought, it may have been lower on your screen. It's because it's gone ex-bonus, 1:5. So there must have been that adjustment. Just for that, the stock is up around 1.5%. Meanwhile, Rima did speak about a couple of these FMCG names which are picking pace. Look at Britannia. That one's moved about 2% higher at the high point. Colgate too, after a very poor performance in this first quarter and no, improvement in the outlook as well. That stock's found some takers. And we have Avenue Supermarts. CLSA is written on Avenue Supermarts. They maintain their high conviction outperform call on the stock. That's up around 1%. So a lot of stocks are in focus. Overall, the mid-cap index is down about 0.75%. The advanced decline ratio much in favor of declines. But we still have a lot of these stocks which are showing big moves.
Absolutely. And we'll touch upon more as we go along. 130 odd points lower now, 24,830. Karthik Kumar is fund manager at Axis Mutual Fund. He's with us. Karthik, good morning. Great to have you with us here. Thanks for joining in. Quick word, Karthik. How is the setup? How are we looking? Running into these tariffs over the last 6-7 days, we've had a nice 6-7 day up rally higher. Where does that leave us as these tariffs kick in now?
I think in terms of just the setup, the construct, it is quite constructive in the medium to longer run. For a couple of reasons, we've underperformed emerging markets by almost 20% over the last 1 year, as a result of which our valuations compared to emerging markets have gone down. They were trading at a premium of almost 90-95%. That has come down to average levels of 45-50%. Granted, a lot of that is because emerging markets are catching up in terms of growth with compared to our own markets, but one could argue it is in the prices. The next thing is that while earnings were kind of tepid, the earnings cuts have kind of, the breadth of earnings cuts have kind of moderated versus last quarter. So for instance, this quarter, we've seen earnings cuts of around 1.5% as against 3.5% last quarter. So the range of the extent of earnings cuts is decreasing, and our earnings expectations around 10 to 11% for this year, which is in line with longer term averages. And I would argue we had taken a lot of that earnings cuts upfront because of the uncertainty that was induced, especially the policy uncertainty that was induced by West and US in particular. And so I think for all those reasons, expectations have kind of moderated, valuations have moderated, and the government has done a fair bit, as we all know, be it in terms of central bank action or policy action. So I think from a market setup perspective, it looks positive in the medium to longer run.
But in the near term, you expect markets to continue to consolidate? I mean, what is the setup positioning looking like, and how would you position your portfolio right now?
In terms of near term, I expect market to consolidate because, as we said, the earnings revision, there is still pressure of earnings revision, especially downward earnings revision. And we need clarity on, especially the GST policy. We need clarity on what is happening with tariffs and so on and so forth. So all of these things will remain an overhang. To that extent, we will be. I expect the market to be range bound in the near term. And our preferences, even prior to the change in the announced change in GST and so on and so forth, was we continue to remain bullish specific consumer themes, including specifically tourism, be it hotels, airlines. We are overweight specific areas within industrial cap goods like T&D, and that is specifically at a house level. And with particular to quant strategies, I continue to remain selectively bullish on PSU banks, and also have reasonable exposure to telecom as well.
Karthik's beaten down sectors like textile apparels, right? Stocks have corrected because they are hit. I mean, there's a clear big earnings hit. But of course, I mean, if one takes a view that eventually it'll be brought low, these tariffs will be brought lower. There is FTAs being signed with the UK, etc. What's your sense? I mean, are any of these viable?
Right now, in terms of my process, it looks like there's still time where you can call it a buy, despite the correction that we've seen in these stocks. And as long as the overhang is there, I would argue that it'll, in terms of US tariff policies, that it will continue to remain a drag on that sector. Now it comes down to timing, and that is the big question there with these stocks and sectors.
What about defense? Do you own any defense stocks?
We have fair exposure to defense stocks. We have exposure in selective areas. So that's another area. And those companies have also reported decent numbers over this quarter. So that's something that we continue to remain bullish on.
Based on your channel checks, which are the segments or pockets where earnings disappointment will continue, say for the next 2 or 3 quarters, where things still haven't improved? And that's a segment you would completely avoid.
So this is where I think market is at its inflection point, where we've seen, let's say, consumer staples, selected areas within consumer discretionary that have reported negative numbers, or that have reported disappointing numbers compared to expectations. But having said that, within staples, you've seen kind of consolidation in volumes, and volumes kind of sequentially improving. And with what has come through in terms of GST revisions or expected GST revisions, that's something that we need to monitor on. So while there may be sectors that were kind of looking negative, going forward, these need to be monitored because the regulatory environment around us has changed to a fair extent.
What would make you positive on staples? Because you are looking at a lot of these discretionary themes. You like hotels, airlines, you like the entire travel and leisure space. But from a staple standpoint, where a lot of the regulatory push is likely to happen, and there are hopes of revival at the rural end and the lower end of consumption in urban as well. Do you think that would provide a pocket of outperformance, say, over the next 6 to 12 months, especially after the recent underperformance that we've seen in the FMCG stocks?
Certainly an area that we are keeping an eye out for, but as of now, we still think we need a few more data points, positive data points, to kind of make that call in terms of having a bit more exposure there. So that's certainly something that we are keeping an eye out for. But I think the stocks have rallied since the announcement of GST revisions. What now matters is the details in terms of timing, in terms of the rollout, and so on and so forth. And then I think we'll be in a better position to make that call.
But what is possible? It's been all over, right? And I'm sure you've discussed this as well. If there are, bulk of everything is moved into that 5% bracket, say, I mean, even for sectors like cement, etc., rate goes down from 28 to 18. What are where do you see the maximum traction in terms of demand picking up, and then consequently businesses doing better?
So, as I said, within consumers, we are still more inclined towards more discretionary rather than staple names, be it value fashion, be it tourism-related themes. There we think structurally there is a tailwind as well, and then GST just adds another level of fillip to it. That's an area that we are positive on within consumer as a space. And as you touched on, cement is another area that we do like, and we think that while cement demand is relatively inelastic to small changes in GST rates, but we still continue to remain bullish that space.
Which are the cement companies that you like right now?
I can't talk about stock names, so I just leave it at the sector level. Sorry for that.
All right. So cement is up. And you said PSU banks, not private sector banks, in your preferred list.
I'm saying we do have fair exposure to private sector banks and NBFCs at an AMC level, but specifically to quant related strategies, I also like PSU, large PSU banks in addition to what I've just kind of reiterated.
And tech, is it an overweight, neutral, underweight? In tech, what would you be looking at if at all you hold anything?
Tech is more of closer to neutral, slightly underweightish to neutral, but it is more bottom up. It is a good mix of actually large and mid cap names. So I wouldn't call it a sector call, but more of a bottom up stock selection process here.
All right, we take that point. Thank you so much for joining in and giving us your view on the market, individual sectors and your preferences right now. But the sector on our radar right now has to be Vodafone Idea and Indus Towers, the telecom space that is Vodafone Idea. It's opened lower. In fact, after a few days of a big up move, Vodafone Idea, the individual stock, the intraday comes up for you, had opened lower. Let's see whether that dip has been bought into. No, still down about 6%. We have Indus Towers, which is taking down the chin as well. Rima, what's happening? Is it the end of the road as far as any sort of relief which is likely to come?
So, you know, on Friday early morning, there was a paper article in Mint which spoke about some relief, the DOT having submitted some relief package to the government. And now it's up to the government to decide whether it wants to provide any sort of relief. So since then, there was a rally in Vodafone Idea shares. On Friday, the share price rallied from about 6.5 to 7 rupees. Then yesterday in Monday's trade, it rallied further from 7 to 7.5 rupees. And now what you're seeing is that rally getting undone to some extent. This is on the back of the Minister of State of Communication conversation with Ashmit Kumar, where very categorically he sort of said that the government is no longer going to intervene. There is no relief coming. And now the government has done what it could. It owns about a 49% stake in Vodafone Idea. From here on, it can't do anything more. And therefore, it's now up to the company to, fix itself. The problem is the company has been unable to do that. They've been seeking some sort of a bank fundraising for a very long time, more than about 2 to 3 years. They did that QIP. The QIP price was about 11, 12 rupees thereabout. And at that point also, despite an overwhelming response on the equity side, they were still unable to close any sort of a debt fundraise. Now they're looking at some non-banking, channels to raise that money. But it's basically now up to the company to, fix itself right now. And what you're seeing right now in the share price is just the rally over the last 2 days. Seeing some getting undone, seeing a bit of profit booking, and it's taken Indus Towers along with itself. Remember, Indus Towers, the street was hopeful that once Vodafone Idea fixes itself, Indus Towers will give you the dividend. Yeah. But, despite, it's been 2 quarters now. The company even set up a committee where they said we will look at, some sort of a share return back to, some sort of capital return back to the shareholders. But they've been unable to do that because Vodafone Idea itself is not fixed right now.
All right, take that point. For the market itself right now, the Nifty is down around, 173, 172 points. Remember, this after a gain of 97 points that we saw yesterday, but over a 200-point fall that we saw on Friday's trading session as well. So the Nifty now with this near 200-point fall is pretty close to where we were at the start of the August series, give and take everything. So, it'll be very important to see whether we bounce back from these levels or not, because a lot of these put writers were positioned at support coming in for the frontline index at 24,750 to 24,800. So very crucial levels for the frontline index. The Nifty Bank not helping its cause. In fact, was an underperformer yesterday as well. And today down by about 500 points, 54,500 thereabouts. Be an important support for the Nifty Bank as well. But amidst all of this, there are a couple of stocks which are surging, Protean, eGov and BLS. They've gotten orders coming in from the UIDAI for Aadhaar centers, nearly 1,500 to 2,000 crore worth orders. Protean, eGov, a bigger gainer out there because it had seen a bigger gash as well as the stock, saw a big decline on account of PAN 2.0 orders not being renewed for them. So that's Protean, eGov, up around 11%. Vinny joins in with the developments in this space. Vinny.
Hi, good morning. So like you mentioned, we have Protein eGov as well as BLS International, both these in focus. Now, Protein eGov, they've received a work order from UIDAI for 1,160 crores. This is going to be for establishing and running district-level Aadhaar Seva Kendras. Time period is 6 years. So every year, approximately 200 crores is what the revenue would come in. Now, do not forget, we had seen earlier this year that PAN 2.0 order didn't come in for Protein eGov. That time the stock had seen a sharp fall coming in, almost 20-30% fall in just 2 sessions. Now, in the last 5 days, that's what the stock has recovered as well, right? Last 5 days, 20% uptick that we're seeing coming in from Protein eGov. And this order size is also similar to what would have come in for PAN 2.0. The PAN 2.0 outlay was 1,400 crores. This order is of around 1,200 crores. So at least covering up in terms of the losses over there. But moving on to the next one, BLS International, that has also received an order from UIDAI, and the order size is 2,055 crores. Time period is again 6 years, and similar service that is for establishing and running district level Aadhaar Seva Kendras. So both these stocks are buzzing on the back of this order win.
Thank you. And we will talk about Narayana Healthcare now. Thank you, Vinny, for joining in. Let's shift our attention now. Sandhya J, the group CFO at Narayana Health, is joining in, and our conversation will be focused on 3 main points: concerns over Bajaj Allianz's cashless facilities, the outlook on integrated care and Cayman Islands, and finally, the company's expansion plans. Thank you very much for joining in. First, let's just get to the news about how some of the hospitals are no longer allowing the cashless facilities by Care Enterprises, which is owned by Religare and Bajaj Allianz. What exactly has happened, ma'am, if you're aware?
So it's an evolving situation, and typically any engagement between a customer and a vendor, when it comes up for renewal, it goes through a certain pressure. Now, this is accentuated in the current situation, and I don't want to specifically talk about what's happening on Bajaj. We have a reasonably working relationship with all the insurance companies, but I do want to talk about generally the challenge that both sides are facing.
Hi, good morning. Apologies to interrupt. Just one clarification, and then please continue. Has Narayana also sort of taken a decision to with regards to Bajaj Alliance?
It is an evolving situation. I don't think any hospital has at the moment taken a decision. Conversations are in progress. And I think it's too early to comment.
Right. If you could give us a sense of what your current payer mix is, how much of that comes in from, insurers, and would you have any sort of breakup on who contributes the most when it comes to insurance companies?
Sure. 1/4 of our payer mix comes in from insurance payers. And like every other organization, we have all the insurance players who... so our mix is very similar to how the market share of the insurance companies are. So it's not a public information that we share our customer composition. So I'm not calling out specific names, but it is very similar to the market share.
Ma'am, just getting back to that earlier point about Bajaj Allianz. So you're saying you're in talks with them. As of now, no decision has been taken by your hospitals to stop accepting Bajaj Allianz insurance, right?
At the moment, yes. The conversations are in progress.
But are you facing some of the issues that APHI has spoken about, delay in payments, etc.?
So I'm not wanting to single out any specific insurance provider at this point in time. But in general, there are issues that both sides face. So from a hospital point of view, yes, we would benefit from renewals happening because typically prices are locked in for 2 to 3 years, which means we are serving at older prices for a long period of time. So if the renewals are not happening on time, then our realization gets impacted. The second aspect is that sometimes we have to engage on deductions and have the conversations to understand why deductions have happened. And based on explanations, there is a lot of effort that is involved for both parties to come to the table to understand the bills and the deductions. So there are issues that get faced there. I would still say that this is typical to how a relationship works. But there is a point that a larger point that I want to talk about here is that maybe what is happening is that there are a lot of inefficiencies with the insurers, and somehow we are conflating them just into hospital charges. Now, modern healthcare is expensive, and we have to deliver with latest medicine, international quality standard, and I think
Ma'am,
last time also.
Yeah, Sandhya, but let me just come in here. We all, and hopefully we won't have to go we won't have too many hospital visits, but all of us do, right? And most of our viewers do as well. You would absolutely agree that healthcare charges have skyrocketed over the last couple of years, over the last few years actually, right? Narayana, of course, and I want to make that mention that you're in that sense much more transparent, and we've spoken about this in the past, and I think even cost of treatment, etc., maybe relatively is a little lower across procedures compared to others. But I don't think you would disagree with the basic thing, basic premise that quality healthcare is, for the vast majority, is absolutely unaffordable in that sense. And it's a question which comes up when we speak with investors about hospitals, etc. They say, well, at some point the government's going to come in and just cap this, because it's getting to be a big problem now. Right now we're talking about from the insurance angle. Are hospitals talking among themselves? You said, well, there are inefficiencies on the insurance side, and that's being conflated with demands for hospitals to fix their side. But are hospitals at least discussing openly what can be done?
So just to go one step back on your previous point in terms of healthcare costs going up, you would also see that the underlying cost profile itself has gone up. And when we spoke last time, I think we had spoken in a reasonable amount of detail on the various costs that are adding up to what hospitals have to charge. Now, the other aspect is that we all know that India is one of the lowest cost of healthcare. Now, while of course it does feel that the cost of healthcare is high because it has gone up over time, but cost of manpower has gone up, cost of imported equipments have gone up, a lot of underlying costs have gone up. But I do think that many times we are confusing the inability of this country to pay for healthcare with the cost of healthcare. We do need a more universal insurance framework for the country. Any cost, whatever be the cost, let's say whatever we are charging today, tomorrow the hospitals decide to charge, say, 80% of that. It is still going to be expensive because the country does not have the ability to pay for its healthcare. So I do feel that we have to pivot into how to make the country able to pay for its healthcare, and which is where insurance and government universal healthcare schemes, etc., play a part. So it's very easy to say from a distance that costs are going up for healthcare, but underlying costs also are going up. And yes.
Yeah, so we take that point, but on this issue itself, you did say that you were facing some of the issues across all the insurers that you were working with, and some of them include the likes of delay in payments, unilateral deductions, a high time in pre-authorization and pre-discharge approvals. For Bajaj Allianz in particular, were any of these issues more than the others?
I don't think it is fair of me to single out a partner. Bajaj Allianz, like every other insurance company, is our partner. And together, between insurance and hospitals, we are serving a customer need. So it is not fair of me to single out one partner and call out issues.
No, but this is something that the APHI has said. So we just wanted to understand from the other side, while you have been facing issues from across the board, has this particular one been a little more accentuated than the others?
I don't think when the matter is under discussion, both through AHPI and on a bilateral basis, I don't think it is fair of me to comment. What I can definitely say is that, we are having ongoing engagements with Bajaj Allianz, as well as AHPI has also created ongoing engagement platforms with Bajaj Allianz, and I'm hoping that we will come to a meaningful outcome on those conversations.
What is a meaningful outcome as per you? What is a meaningful outcome as per you? And when you are engaging with them on, these issues, what is it that your side of the discussion is saying or proposing?
Sure. A lot of it has been highlighted in that AHPI note, I think, which is public. But if you look at us, I started speaking about it. We need to renew on time. B, we need to have a mechanism by which our cost inflation is taken care of in the contracts. C, we need to have a seamless way of working at the time of claim settlements. Both from a customer experience point of view, because even customers are facing deductions at the moment, and therefore they're having to co-pay. Different insurance companies are at different levels, anywhere between 10% of the bill to 50% of the bill customers are having to co-pay. And after a claim is approved, sometimes we also get deductions. So we need to have a way of working sorted out on those areas. So it is like I said, some of these are bilateral. On a transaction by transaction basis, we do discuss. And at the overall framework level, I think AHPI is engaging with the insurance company.
Ma'am, just one more point. Coming back to that earlier argument that you were saying, that while the cost of healthcare has gone up, the cost of healthcare has gone up. While we're paying more, even for you at your end, you are paying a lot more. The cost has gone up. I was just looking at your margins, ma'am. In FY24, 10 years back, your margins were about 10%. And now when you end FY25, your margins were 23, 24%. So while in an absolute terms, yes, costs have gone up, but you've also benefited. Your margins have doubled.
Okay. I want to answer this question in two parts. One is that you are reading our overall margin, including Cayman. Our India margin is around the range of 20%. When I gave my interview to CNBC just, I think, 1.5 months back, the first question that you asked me was that, we were expecting you to be at X margin and you are at Y margin. And why are you not at X and why are you not able to sustain X? But the reason why you are asking that question, it's a fair question, because there is a certain margin threshold that we will need to work with to generate adequate cash flows so that we can reinvest. If you see, healthcare is probably the only sector which reinvests all its cash flows into capacity. You take any hospital, all of them have a model by which as and when they generate cash flows, it goes into new capacity, and new capacity is what is needed for the country. So if you just take EBITDA as a number and say, oh, your EBITDA is so much, I think it's not a real representation of what the sector is doing. You have to see what the sector is. For example, I will take our example. I can't comment for other hospitals. Every third patient we treat in our hospital comes either on a subsidized scheme or on a government, which actually pays many times low cost. Yeah. Now, I cannot do that cross-subsidy if I am not making healthy cash flows and have a balance sheet or P&L that can support it. We are investing, I think your third question, which is our expansion question, we cannot deliver that expansion until we have a cash flow that can support it. So we'll have to look at the health of the industry also, and what the industry brings value to the customer in such issues that we bring to the table.
Well, it's a complicated issue. It's a bigger question, and I think it'll require many more debates, discussions, etc. Sandhya, thank you very much for now, for being with us here to talk us through your point of view at Narayana and, of course, hospitals overall. Stocks at about 1800, 1812. Markets have sold off. 200 points lower on the Nifty, 24,770 is where we are at the day's low almost. We take a break. We're back. And of course, we focus once again back on the tariff, the Trump tariffs which kick in, the secondary tariffs which kick in from tomorrow morning. Amitendu Palit, Senior Research Fellow, ISAS, NUS, will be with us. We'll also connect with former Commerce and Industry Secretary Ajay Dua to talk about all of this. Stay tuned. Welcome back. 200 points lower on the Nifty, 24,770 is where we are at the day's lowest point. Market breadth is negative. So 500 stocks are higher, 2,000 stocks are lower. So a day to go for the US tariffs to kick in. and the tariffs are 50%, 25 base plus 25 additional secondary tariffs. We'll, of course, we've been tracking this, and as I just said, we will be speaking with some experts in just a bit. But here's Mark Mobius, chairman of Emerging Opportunities Fund. He's an emerging markets veteran. Has said that his belief is that India perhaps is the best performing, is going to be the best performing emerging market in the world. Listen in.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the U.S. The garment industry, of course, will be hurt because a big portion of their exports go to the U.S. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous. India's got an incredible domestic market, and more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the US, which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the US, I think the Indian economy will still be doing very, very well. We've actually reduced the cash. It's about 25% now, but thank God that we've been having this cash, because with the markets at these uncertain terms, particularly India, we're being more cautious, and we have to be careful in putting money in. Of course, if prices of the stocks we like come down dramatically, we'll be putting more money in the market, because at the end of the day, we like prices that are depressed. At the end of the day, India is still going to do very, very well from a longer term perspective. And if you look at the Nifty 50, it's still at a high point and probably going higher. I can see the Nifty 50 going much, much higher than where it is now. And of course, once this trade war is over, you'll probably see a lot more good news coming out of India. By the way, one of the interesting aspects of this whole thing is that as a result of the pressure that the Indian government is having, you're going to see them making more and more changes in the, let's say, the GST, the tax system, to make it simpler for businesses to operate. And there'll be a lot of reforms which will help the Indian economy grow at a better rate. Because a lot of things that are holding back the Indian economy, of course, is the bureaucracy and the complicated tax system.
All right, an all-time India bull saying that very near term he's a little cautious on putting more money in India, has raised India cash levels by around 25% as well. That's Mark Mobius, even though he believes that the long-term prospects for India are good. The near-term concerns around the tariffs are something that, everyone's a little jittery about. So let's discuss this and more. We do have Amitendu Palit, who is a senior research fellow at ISAS NUS, joining in. Thanks a lot, Mr. Palit, for joining in. The obvious question, what happens now? 25%. The street was expecting in the long term India would be favored versus other nations. Not only has that flipped, but now 25% with the threat of that going to 50%, give or take the exemptions. It's definitely not in our favor so far. Do you think there could be something that could flip it?
Firstly, thank you for asking me to join you on this show. I was going through the executive order that's been brought in by the White House. It's actually a very complicated order in the sense that, as you said, there are certain kinds of exemptions, in the sense at least there's one relief that the Indian industry will be happy to have. There's not going to be any stacking of the Section 232 tariffs, which are already effective on steel and aluminium and automobiles with these tariffs. So that part is clear. Second, there are a large number of exemptions over and above the items that were already exempted in the Annexure 2 of the first reciprocal tariffs order that was issued on the 2nd of April. So there's a bunch of items which are going to face these tariffs, and some of these clearly are items which are among India's major exports to the US. But having said that, the order mentions something interesting, and that's the provision of a drawback. Now, it's not yet clear what this drawback is supposed to be. How can there be a duty drawback effective? All those details are not coming out. But I think, largely speaking, the couple of industries that are taking center stage at this point in time is basically garments, which is expected to go under the radar for some time in terms of the hit that it might take in the short run. There's leather, there's jewelry. But having said that, again, let me come back to the point that these are essentially sectors which, even without a 25% Russian tariff, would have been impacted in a relative sense, because India's reciprocal tariffs at 25% are by and large higher than most of its competitor countries in these industries. But on the other hand, I think the global financial and investment community, particularly since you guys are clued into the market, you'll be able to sort of back me up on this, I think, much more resolutely, that I think the markets continue to retain their faith in the long-term prospects of the Indian economy. Those, I think, have been confirmed by the ratings that have been recently released by Fitch and S&P, and also from what Mark shared with us earlier in the meeting. I think the long-term growth prospects of the Indian economy, and along with that, the returns on long-term investment, which investors are planning for the economy, all remain stable, not just because of the domestic economy fundamentals, but also I think there is this faith in the ability of the Indian economy to also maintain its exports. And finally, I'd like to draw your attention to one point. We have been talking about the India-US economic relationship having taken a hit. There is a very significant section of the India-US economic relationship, which is the trading services. That till now has not been affected because that has not been the target of tariffs. But the latest pronouncement from President Trump on Truth Social is that his focus is now going to shift to the quote-unquote behavior that different countries mete out to the US tech companies. And he's particularly going to watch out for digital taxes in this regard. Now, my sense over here is that the US tech, and particularly the big tech, is very deeply invested in India, and they are likely to become a very crucial group of actors in maintaining that part of the India-US economic relationship, which over time can also eventually lead to slowly certain other tariffs being taken off on India.
So the leverage that India has is actually its IT services exports. Just the way, for instance, the leverage China has, which is why negotiations with US have been still ongoing, is to do with rare earth magnets and so much other. You think what will help India eventually get a reasonably favorable deal would be its IT services exports? Or is there any other leverage that we have?
Yeah. It's not just the IT services. I think there's a huge amount of leverage India enjoys insofar as the patented services, the legal services, the professional services that the US disburses in India, and the revenues that its service providers earn from India. And there's already this talk about whether these services might be the subject of retaliation on part of certain American trade partners. India hasn't yet come into that conversation, but there are countries like Brazil, which in the past have taken steps on, notifying their actions on US patented services, so much so that the US revenues from those markets come under threat. But the bigger point that I'm trying to make over here is that it is in the United States business interest to actually maintain this services trade in as robust a fashion as possible, the way it is going and the momentum is being maintained. So I think that is where the ball is actually in the American court. And I think President Trump and his group of people are sensible enough to understand that.
Point taken. I actually want to flip that question on its head, Mr. Palit. Good morning, Prashant here. We also have Mr. Ajay Dua joining us. Mr. Dua, good morning. Just coming to you, sir. But Mr. Palit, if I can come to you, the way you began that the answer before the last, which is on the last post, he said, well, he's going to pay attention to what countries do on the digital tax side. I mean, is there a bit of a threat there that he's so far not mentioned services? I mean, and I really hope that's never on the radar. That's going to be a huge one. But is there a risk at all that you were referring to?
Good morning, Prashant. You'll recall that 3 months ago he had mentioned that countries which create barriers to Hollywood films will be slapped tariffs on. Now, at this rate, if he is trying to slap tariffs on every possible action that countries enter into, I don't really think that is practical. That threat is running out of its power. And at this point in time, if you discover that a country like India maintains a digital services tax, which many other countries of the world do, and which are all going to get eventually amalgamated under the BEPS minimum value of taxation, tariffs are not really going to make much of a difference at all, because even this current order on the Russian tariffs that has come is an order which is not comprehensive. It is actually selective, if I can define it that way. And if you take a look at it vis-a-vis the earlier precedent orders that are over there, I think there is no further new cause for India to worry as far as the hit on the exports are going to be taken. The older worries remain. Perhaps to some extent, those sectoral impacts increase. As far as the new threats are concerned, I'm pretty sure there are going to be threats, and this is something which is going to be of bigger concern to the countries which have already signed deals with the US. Because by now, they should understand that no deal with the US is good enough. So I think that's the point which needs to be noted and then move forward. Perhaps that puts India in a better position than the others.
No, you're absolutely right. I mean, who knows how all these promises of investments to avoid tariffs, I mean, take the case of semiconductors and chip companies, how much of this will materialize in the next 3.5 years? What after? I mean, it's all up in that sense. And even all these deals, we don't have details of, right, with other US and other countries. They're all so far just headlines in that sense. Mr. Dua is with us. Mr. Dua, your thoughts, sir, as these tariffs kick in, go into effect? How should I mean, our viewers look at this? The general feeling, of course, has been that it's 25 plus 25, but this is, of course, can't be permanent. Maybe it'll be negotiated lower, but timelines are unclear. How do you think about this, Mr. Dua?
I think, thank you first, Shant, for having me. I'm sorry I'm joining a bit late. I think for the time being, we do have a situation in hand which we will need to boldly face, which means that from tomorrow, we are liable to pay a 50% duty on all our exports to the US, which at about 55% of the $90 billion means on about as $52 or $53 billion, we would be required to pay an additional duty of 25%. But that shouldn't bother us too much and for too long is what I would like to emphasize. We are nothing but a collateral damage of Russia and the US not seeing eye to eye on Ukraine. It's no more than that. The oil, our continuing to import oil from crude oil and LNG from Russia is merely an excuse to put pressure on the United States, pressure on Russia. Mr. Trump feels hurt, feels disappointed that he had promised the world well before he was even elected as the president for the second time, that within no time he will have the war in Ukraine stopped. He finds himself helpless, and a little bit of belligerence from President Putin post the Alaska summit has, I think, egged him on to take the action against the weakest possible link in the chain. Otherwise, why not action against China? Why not action against the EU, which also have continued and are continuing to import the Russian oil?
You're absolutely right. Mr. Palit, have you looked at numbers, sir? The cost benefit? savings on Russian oil vis-a-vis hit to exports because of these 25% tariffs. If you can, I'm sure that kind of scenario analysis exists with the government, right?
At my end, Prashant, I think, no, I haven't gone into a detailed estimate of that. But what I can share with you is that, Prashant, in this respect, the focus should actually be on the kind of sanctions that have come from the European Union as opposed to the US ones, because the US ones are talking about tariffs. The European Union sanctions are actually talking about lifting oil at a particular threshold price. If that price or anything below that is the price for buying oil, then that is acceptable. But anything above that is supposed to add to the Russian revenues, and that is not acceptable. And that is a threshold which has been calculated. The $60 per barrel appears to be the mark, and 20% below that is the threshold, which or anything below that is acceptable. Now, from an Indian perspective, these prices are varying very, very significantly. But on the other hand, if the trade-off is that you start buying more and more of the American barrel as a one-for-one substitution, which right now is at $65, then obviously the costs are significant. But I think I'd like to go back to the larger point of, taking a look at the GDP and the contraction that is expected. I think I'm pretty confident that it's not going to be a significant part. Otherwise, by this time, we would have had the Reserve Bank of India coming out with some feelers in this regard. They have held the GDP growth unchanged at 6.5%. And at best, a 0.5 percentage point this way, that way might be the aberration, which depends much upon how the dollar behaves, how the inflation in the economy shapes up.
All right, we take that point. Thank you so much for joining us and giving us your views. Let's hope, for a better, sentiment both in the India and the US, better prices for them. This actually gets to a level which is a lot more acceptable to both the nations and a lot more favorable from a market standpoint as well. Good time to get in, the market checks as well. We do have the Nifty still hovering below the 24,800 mark. We do have Mr. Shetty, Nagaraj Shetty, who's the Senior Technical Research Analyst, HDFC Securities, joining us now. Nagaraj, over the last month or two, the Nifty has been consolidating. In fact, even if you take into account the big move that we've seen over the last 5 or 6 days, for this series, the Nifty is up just about 23 points. So the range keeps moving either higher or lower by a couple of 100 points. And within that 100-point range, the market has been oscillating. What do you think the charts are suggesting from a near, medium and long-term standpoint in the frontline indices? And any sectors that you would like to call out?
Hi, good morning, Mangalam. No doubt, Nifty has been a short-term downtrend from the higher levels. Selling pressure has emerged. The initial support of 24,800 just on the verge of breaking. I think the way Nifty has moved up recently, after that, before coming into this recent correction, it has changed the sentiment of the market, and the gap that has opened on 18th of August. I'm expecting that is going to be a crucial gap support for the Nifty from any decline from here onwards. Currently, the gap has been entered on the downside. At the lower level, the gap support is placed around 24,700, 650 odd level. I think that is going to be a strong support for the market, and we could see Nifty bouncing back from the lower levels by today or tomorrow in the next 1 or 2 sessions. There is a higher possibility of Nifty showing upside recovery from the lows of around 24,700 to 24,650 levels in the near term.
Thank you for joining in. Any quick stock calls?
I have 2 stocks. One from auto side, that is Bajaj Auto. Technically, Bajaj Auto was moving in a larger range bound action. Recently, it has broken above the range and currently showing some consolidation, showing some resilience during this week. Broader markets currently trading around 8786 levels. One can look to buy at this point of time. An upside target would be around 9,300, 9,300, and one can place a stop loss of 8,500. And second one is SJVN. Chartically, SJVN has been in accumulation phase over the last many weeks. We have seen some good outperformance recently. It is currently placed at the edge of breakout of the 200-day EMA. It has been a strong resistance over the last 1 year. And I think the overall chart pattern is indicating a decisive upside breakout of this hurdle in the near term. Currently trading around 100.70, one can look to buy at this point of time. The immediate upside target would be around 107. One can place a stop loss at 96.
Thank you. We leave it here, get into a break. On the other side, Manisha Gupta will join in to focus on the commodity space. Stay tuned.
Welcome back. Markets, of course, are not doing all that well. Nifty is down 160 points, off the lows by a bit. Commodities in focus with Manisha. Manisha, good morning.
Morning, Prashant. Thank you for that. I'm talking about a couple of sectors which do not like the kind of tariff increase that we've seen come in for the country. 25% tariffs were done on 7th of August, and we have a total of 50% coming in from the 27th of August. Now, I'm talking about the gem and jewelry sector, first of all, and this is going to be really badly hit. $48.2 billion of Indian merchandise will will attract tariffs going forward from here. And when you look at the gems and jewelry, well, we are looking at higher numbers here as well. So gem and jewelry sector, US accounts for nearly 30% or $10 billion worth of export is what we've seen in FY25. Now, this sector is going to be very badly hit because when you look at the other peers and other competitors, India does turn incompetitive rather, in the international markets there. So while India will be staring at 50% from 27th or 28th of August, take a look at the other countries on what they are looking at in sense of tariffs. You have Turkey at 15%, Vietnam 20%, and Thailand at 19%. So other countries which are in direct competition with India will be looking at 15 to 20%. While India stands at a very tall 50% on this one. Well, diamond jewelry is one part of it, and diamonds is yet another, because the world's largest hub for diamond cutting and polishing is India. 9 out of 10 diamonds are cut and polished in India. So when these diamonds go to US, which is, by the way, a 50% for Indian market, this is going to be heavily tariffed. So this is something that the industry is pushing for, treating diamond as an input or a raw material and perhaps exempting it at this point in time. The tariff impact will, of course, increase the cost for India. The Indian products will become less competitive. That could lead to lower sales. The calculations for the month of August, in any case, have been on the weaker side. And going forward is Christmas and holiday season. This is a season that the industry says perhaps would be completely amiss. This could threaten livelihoods, stall exports, and disrupt supply chains as well. The street also is looking for a lot of employment being hurt as well. The industry is calling for government intervention, including strong diplomatic talks with the US. It also is about asking for relief schemes from the government in sense of supporting exports, exporters, and the smaller units as well. In addition to that, the industry is asking for duty drawback schemes. There also is an ask for market access initiative scheme, deferment of interest on working capital. There's a lot of manufacturing that perhaps is getting shifted to Dubai, Mexico. The industry has already started visiting these countries, understanding licenses laws there, so that perhaps manufacturing units for export especially could be shifted out of India. Industry also is warning of a potential job losses for nearly 5 million workers if this extends any more than 3 or 4 months. The next 3 or 4 months is going to be about domestic demand. This is another thing that the industry is asking for. If the stuff that was perhaps going to be exported now can be sold into Indian retail stores. That conversation, we understand, is going on right now. A lot of labor in any case had shifted to lab-grown diamonds, but that also is looking at a tariff impact at this point in time. The other important area to look at is SEEPs, where Mumbai hosts 200 exporting units and employs 50,000 people. We also do understand from the gem and jewelry segment that they are in conversation with chief ministers of UP, Gujarat and Maharashtra. This is where you have major employees coming in for or units being set up as well. So in case if that can be really worked on and the losses in sense of EMIs, etc., that these employees are paying can be taken use of. So that's about gem and jewelry sector. But $10 billion worth of exports is what India also does from textile industry in the US. FY25 did show those kind of numbers there. So when you look at the total overall exports, $37 billion is what we did, and $100 billion is a target for 2030. That industry feels perhaps is not going to get fulfilled. That really is the number, because, you know, when you look at woven apparels or textiles, there are different tariffs already there. So this is going to be in addition to 50%. So when you look at knitted, it's perhaps going to attract 64%, and woven could be looking at 60%. So when it comes to tariffs, India does stand to lose with its peers, which is Bangladesh, Vietnam, Pakistan, Turkey for that matter. So these are dire sectors, these two of them, gems and jewelry and textile, where there is an expectation that the government perhaps will do some hand-holding, whether it is about working capital or it is about job losses, because these are very labor-intensive sectors as well. So with 50% staring in face now, there are a lot of expectations coming in from the government.
All right, those are very high numbers. One just hopes that they don't last for very long and they are negotiated lower. Manisha, thank you very much for that detailed explanation. Time for a quick commercial break here. We're going to come back. It's the economy with Lata. She'll talk about the impact of exactly the tariffs on Indian goods exports to the US. Santanu Sengupta of Goldman Sachs and Saumyakanti Ghosh of SBI join her for that discussion. Stay tuned.
happy Ganesh Chaturthi to everyone. The mighty Lord Vignaharta is the destroyer of obstacles, and at the moment India is facing a rather big obstacle in the form of the 50% tariffs. Well, let me start with the good news. Some goods like pharmaceuticals, autos, auto parts and metals like iron, steel, aluminium and copper continue to attract 25% tariffs. The Global Trade and Research Institute, or GTRI, calculates that out of India's $86.5 billion exports to the US last year, $60.2 billion of exports are going to face the 50% tariff. Now, of course, what can be the impact of the possible loss of markets on India's GDP? Most economists assess the impact to be about 1%, but with only half the year left, the impact is probably 0.5%, but there are other countervailing issues like the GST cut. These are all rough estimates. To understand the macros, the macro implications, I'm joined by two stalwart economists, Soumya Kanti Ghosh of State Bank of India, also the economist for the Finance Commission, and Shantanu Sengupta, the economist from Goldman Sachs India. Gentlemen, good morning and thank you very much for joining us. Soumya, to you first. What should we assess? We are going to get one GDP number on Friday, but nearly 6 months of the year is left. What can be the impact?
Oh, thank you, Lata. I think there are two things to this. And the first quarter GDP number I think this Friday and the overall GDP estimates, I think there could be two different narratives. The first quarter GDP number will be quite strong, but look into the nominal GDP numbers because that will give an indication of how the economy is doing in terms of an declining domestic demand. So our sense is that the real and the nominal are likely to converge significantly in the first quarter. So, but the good news from that is that while the numbers of real GDP will be strong enough, the overall for the full year, that may cushion the impact of a fall in the second half because of the tariff impact. Now coming to the downside, I think with the US tariff now kicking in from today, and India, as you know, has an export surplus to US of around 45 to 46 billion. Overall exports is around, I think, 86 to 87 billion. Yes. So even if 50% of that is supposed subjected to tariff, there are varying estimates, but I take the ballpark estimate of 50%, which is closer to our estimates. That means the trade surplus which we had with the US will be eliminated over a full year. But given the fact that if you actually look into the exports to India, USA in April and May this year, that has been actually grown faster than last year because of front loading. And this could have continued till August, I think till the mid of August, when the exporters were actually exporting to take advantage of this, not for the tariff to take impact. So overall, I think there will be, of course, an impact, but there are many ponderables, moving ponderables. Hopefully, if we get a trade deal when there is a visit by the Honorable Prime Minister at the end of September to US, I think that will be good enough. But in our sense, there will be, of course, some impact on the GDP. How far that is cushioned by the cut in GST, that remains something which we need to explore.
Okay. Well, I know for everyone, this is too many moving parts and work in progress. But Shantanu, the average I got from my poll, which I did for the Friday numbers, the average for the full year is coming at around 6.2, 6.3%. What kind of a further downside? Are we staring at sub 6%, assuming that we have to pay 50% for the remaining 6 months of the year?
Yeah, Lata, we are already at 6.1 for the fiscal year 26. We haven't baked in the incremental, which is going to come into effect from tonight. If the incremental comes in, or if on the initial part, our assumption was that the elasticity would be somewhere in the region of 0.5. It's also backed by some research at the sectoral level by the IMF in over the last decade. But if the incremental 25% is to come in on ballpark 60 to 65% of overall exports, it's very likely that the elasticity will be closer to 1 and not really 0.5. At 50% tariff, it is very difficult to export. And therefore, we think that some of these sectors like textiles, gems and jewelry, marine products, etc., will be quite impacted. So, the risk is that you have a number sub 6% for the fiscal year 26. Again, the big uncertainty is as Shomya said, when this gets rolled back quickly. If you have a deal by the end of next month, this all could be rolled back quickly, and therefore you can again have a growth upside. But as of now, if this stays, just the first round arithmetic tells us that growth would go sub 6%.
Okay. Yeah, that is the fear. But Shomya, obviously the government will try to do some hand-holding. Now, some of the things that the exporter organizations are asking is, the best they can get is the full 25% reimbursed to them for 1 year till they find, alternative markets. There are others who are asking for not the full 25%, but at least say 20% being reimbursed. There are yet others who are asking for, just interest mitigation through a CGT, MSC or some such package. So, first of all, should we be prepared for a higher fiscal deficit or a higher fiscal spend? Because it's a large number of employees, textiles plus gems and jewelry plus leather, plus shrimps.
I think as of now, fiscal deficit at 4.4%. I don't see any significant upside risks, although I think there will be clamor for more support to the exporters. I think the one way the government is already looking into cushioning the impact. I think one way the government could actually look is that, I think if you remember last year in December 2024, the export credit, the interest subvention scheme was discontinued. So one way is to bring it back and only for a limited period to the sectors which are impacted, specifically the textiles, gems and jewelry, marine products and others. So that is one way of looking into the thing. The other way actually just to ride over the current storm and see how the impact plays out. I think the government is also trying to assess the situation to see whether we are able to strike a trade deal. Maybe later now, not sooner, because it's already the end of August. So even if you're able to strike a trade deal, maybe by the end of September with some giveaways here and there, I think that's the idea which is going on in the government mind. So in my sense, I think maybe for the next couple of fortnights, the government will actually wait and watch to see how the things are spanning out. And then it will announce the impact. And then it could announce a package. Regarding the impact on fiscal, we are open that the fiscal deficit, which is a 4.4%, even if it slips by a 5 to 10 basis point impact, which is possible given the GST implementation, but also that could be offset by higher consumption. I think that is still better than taking a GDP hit of larger GDP hit over the next year or so. As of now, I think again the impact on GDP will be significantly uncertain. We have already been around 20 to 30 basis point impact, but this 50% tariff could actually hurt the GDP a little more if it continues.
Okay, the impact on bonds is at the moment 6.61 is the 10-year. Remember, the 10-year end May was 6.17. There are other reasons why, of course, the yields have gone up, simply because everyone is staring at the end of the rate cutting cycle. But Shantanu, what kind of a fiscal impact? You're not looking at a package. You don't think the yields are reflecting the fear of higher fiscal spend and maybe lower fiscal earnings as well?
I would say, Lata, that there are risks to the fiscal deficit from multiple factors. By our estimate, the income tax cut of 30 basis points of relief for the consumer was not really fully budgeted for when the budget was announced. The budget announcement was about 10 basis points of GDP higher for the income tax collection, which would have assumed then job growth or something like that, which we don't think is really happening. Second, nominal GDP growth, Shomya made this point earlier, nominal GDP growth will be lower. And three, now you have the question that you're asking, which is these sectors, mostly MSMEs, will need some form of support. Now, the support can be through a direct subsidy, in which case it is a direct hit to the fiscal for this year, or it could be through what you saw during the pandemic, maybe a credit line or something on those lines. So it depends on at what point of time you take the hit and through what instrument. But I would say that already that is reflecting, as you correctly pointed out, in the back end of the yield curve where yields have backed up. So the market is, I would think that the market is aware of the fact that some of the fiscal risks are brewing because of not just the tariff, but also nominal GDP growth being lower and the income tax cuts.
Yeah, and the dollar is more expensive by 20 paise overnight, and about 50 pies if you take last 48 hours. Soumya, are we going to stare at 88 very soon?
Yeah, just one point, Lata, I want to mention. I think the feeling in the markets is that the impact on the states could be even more than the centers. That's why I think, as you know, the SDL, I think there's significant upside, the borrowing SDL estimates. And in fact, I think as of now, we are holding our gun and we believe that things could actually get better before it gets worse. But our sense is that there will be an impact on GDP by around, say, 20 to 30 basis point as of now. But beyond that, to speak about an impact when we are actually getting back to an era of protectionism of 1980s, what used to happen in 1980s, that infant industry argument, I think is very difficult to say at this point of time what was the overall picture. But as of now, there are, of course, the downsides could outweigh the upsides to some extent.
Well, truly spoken like a Finance Commission member that the states are going to be impacted more and the SDL yields have risen. Gentlemen, completely out of time, but I will invite you all for a more thorough discussion when, things get clear a bit. Also, Shantanu, apologies that we couldn't discuss your excellent report on financial savings, which states that India is probably staring at about a 13% of household financial savings from the current 11% odd. And that will mean some, $10 billion flowing into financial assets over the next 10 years. We will discuss those reports at a time which is more opportune. Thank you very much, Soumya and Shantanu. Wrap up on Bazaar. Chart Past is coming up.